Why is this? Am I in focus? I think I'm. Something that I terribly recommend for every single trader out there, although I believe that trading a very small basket of stocks is a lot closer to what the truth should be for most traders than being all over the place trying to master every single thing that moves. Now, Apple today came out with earnings. And quite naturally, because I trade Apple every day, I got a barrage of questions and emails and PMs, private messages on all the various social networks. Oliver, what do you think? The earnings of Apple came out. You trade it every day. What's your take on this? And it led me to believe that if I'm receiving such an overwhelming number of questions regarding this earnings report in the stock that I trade every single day, that these aren't the only people who might need some guidance in terms of how to interpret this. So while I would never in a million years make my vlog about specific numbers of earnings reports or anything like that, I think that is incredibly boring. What I do see the opportunity to do for my traders, my followers, my family, my supporters, is share with you a theme that has basically helped benefit my trading career in a very big way. This theme, and it is an earnings related theme, this theme, traders, will give you a very general but very valuable take on how to interpret the earnings reports of any company, not just Apple. And I am going to have to go to the chart of Apple to actually demonstrate this theme in a very detailed way. But I promise you, after spending a good 10 or 15 minutes with me with this theme, you will emerge from our time together a lot clearer on how to interpret earnings and what to expect in the days and weeks after, in the wake of earnings reports. Now, let me summarize before we go to the chart. The markets are anticipatory in nature. Most players never even reach the point of understanding that the market attempts to trade on a reality that does not exist yet. In truth, the market is attempting to anticipate what the next 8 months is going to be. So if a market in general is moving up, it is moving up on the promise, on the assumption that 8 months from now, things are going to be better. If a market is moving down and moving down thoroughly, the general assumption by the collective participants of the market is that 8 months from today is going to be worse. So, if we take that theme and combine it with earnings, we can come up with a set of probabilities that gives us an edge as market participants. Now, hear me out just for a moment here. If for the last several months, a particular stock like Apple has been aggressively moving to the upside, and after this multi-month move to the upside, an earnings report comes out that's positive. The positive nature of that earnings report was anticipated months before the report. In fact, the stock was moving up in anticipation of the earnings report being positive. Many people don't understand why a company can come out with positive results and actually experience negative downward pressure. A company can blow out all estimates. A company can beat all expected numbers, and yet the stock collapses, and sometimes in a very, very aggressive way. Well, the key is always, what has the stock been doing prior to the report? Because if you bought in anticipation 2 months ago, 3 months ago, if you bought this stock in anticipation that the next quarterly earnings were going to blow out numbers, and the company actually does blow out numbers, that becomes a sellable event to you, not a buyable event. Novices want to buy the good news. Professionals are looking to sell the good news. This is the number one difference between those in the know and those not in the know, that the market is anticipatory in nature. It is not trading on the current reality. It is attempting through the current reality to extrapolate what's going to be the future reality. And this is what many people do not understand. So think about this. If the company has been going up for 4 months in a row and the earnings is good news, that good news is a reason for the vast majority of the holders, those who have been waiting for this event, to sell, not to buy. If the company, conversely, has been declining quite rapidly and quite aggressively into earnings, and the earnings report is negative, oftentimes there might be a knee-jerk reaction to the downside, only to have that initial downward movement dramatically reversed because the downward movement prior to the bad earnings report had the bad earnings report priced in already. So it was already being sold. It was already being distributed. It was already declining in anticipation of the bad news. And that becomes more of a buyable event. Most novices have this backwards. Now, when we go to the chart of Apple and I show you this more specifically, you're going to see exactly what I'm talking about. So why don't we go to the chart right now? Give me a good 7 to 8 minutes additionally of your time, and I promise you, you'll emerge from this video, from this vlog, being a lot more astute. Your level of market sophistication will have been raised, and never, never again will you be greatly stupefied by the earnings reports of major companies. Let's go to the chart right now, and after this brief charting session, I'm going to come close you out. Okay, traders, what we're looking at is a monthly chart of Apple. Every bar, every green bar and red bar that you see on this chart represents one full month of trading. Now, we're going back all the way to portions of 2006. Now, I've been trading Apple every single day of my trading life since 2001, actually. As I mentioned before earlier in the blog, I believe there are very few people on the planet who have a greater intimacy and feel of the stock, how it moves, its characteristics, its idiosyncrasies. Now, keep in mind that a stock essentially does not have a life of its own. I mean, for the sake of linguistic convenience, we actually refer to the stock as if it had its own personality and its own ways. The life of a stock is truly made up of the collective consciousnesses of the individual participants. So the stock represents a personified movement of millions of market participants that frequently and actively trade Apple. So in a very real sense, you're not trading Apple when you trade Apple, or any stock for that matter. You're trading the collective group of individuals and entities and organizations that regularly play the stock. So when you hear cliches like the vast majority of trading is psychological in nature, that is absolutely true, because we're trading people, not stocks, essentially. And what moves people? Predominantly fear and greed. A little bit of ambivalence as well, but fear and greed are the two dominant motivators of people's actions. So we're attempting to determine when greed is in effect and when fear is in effect. And more importantly, when the baton is passed from greed to fear, and when the baton is passed from fear back to greed. Any market participant who gains any degree of consistency with his or her ability to determine the moment that the baton is passed with frequency, with consistency, will be a master of this game. The name of the game is being able to read the shift and the transfer between fear and greed. That's all trading is. Now, let's get back to the point of Apple and its earnings. As I was mentioning before, the market is anticipatory in nature, which basically means, right, that a run-up in a stock is running up in anticipation of something in the future, usually 6 to 8 months in the future. And when a stock is moving down, it's moving down because it's anticipating that 6 to 8 months later, things will be worse than they are today. Because if the assumption is that they will be better than they are today, then there would be purchases. There would be more buying than selling. Okay, now let's leave the notion of whether the assumption is right or not. That's not important. And this is what a lot of novices get wrong. They're looking for the truth. They're looking for what is real. They think that will make them a better trader, when you have to monitor more of what is. So it doesn't matter whether the collective participants in Apple believe that 6 to 8 months from now, things are going to be worse off, and they're dumping the stock, and that is applying pressure on the stock, which causes the stock to decline. Whether that assumption is correct or not will not negate the fact that the stock is under pressure and declining. And even if the assumption is that things are going to be better in the future, whether that's right or not is besides the point. The fact is that there's more buying than selling. There's more supply than demand, more accurately, actually. And the stock is ripping to the upside. Now, let's take a look at Apple in the sort of middle of 2016, here at the low around $89, as you can see. Now, at this particular point, Apple had been going down for an entire year. As you can see, this is January 2015, and this is January of 2016. So basically, since the first quarter of 2015, where Apple topped out close to 134, Apple's been under pressure the entire year, for one entire year. Now, what's interesting is that after Apple has temporarily bottomed out around this $89 number, not quite 89, but close to 89 down there on the chart, we've been going up predominantly. There's a month of a pause here, but predominantly 1, 2, 3, 4, 5, 6 months Apple's been running up to the upside. Now, today's earnings report comes out after a 6-month run. This run was in anticipation of the earnings report of the latter part of 2016. We're now getting the results that the anticipators down here were anticipating. And so if you were a large accumulator down in the low 90s in anticipation of fairly decent results later in the year, when the iPhone 7 and the iPhone 7 Plus and things of that nature were going to be coming out, you're quite naturally going to use good news as a profit-taking event. It is not going to be a buy event for you. Those who may not be in the stock and are not totally astute in terms of how to play the market might be thinking about buying because the news is good. But professionals predominantly are looking to sell on the news because the markets are anticipatory, and the players, the real players, the professional players have been accumulating in anticipation of this news. So in a sense, it will not matter whether the news is good or bad. It's a sell event because there has been a 6-month movement up in anticipation of it. So I'm not necessarily guaranteeing that Apple's going to be under pressure, but the odds are extraordinarily high. We can't ever know the future, but we can become good probability experts. We can become good at reading the odds. The odds, to me, suggest that Apple will likely be under pressure, even if there's a temporary run-up because of the knee-jerk reaction to a fairly decent earnings report. That report is more of a sell event for the pros than it is a buy event. Now, we're not talking long-term. Long-term, I am an owner of the stock. I have owned Apple in my personal portfolios from $14 pre-split prices, which basically means that I've owned it from $2 and change or what have you. But I'm not talking long-term here. I'm talking short-term. So I believe that Apple is likely to have some sell pressure hit it over the ensuing days and the ensuing weeks. But that's not the important point. my purpose of conducting this vlog on how to play earnings is to give you a lifetime or lifelong theme to apply to your particular market play. That I don't want my followers and my traders and my supporters to be thrown by an item, earnings, very important, that often throws the vast majority of the participants out there. There are professional talking heads on television who still do not get this. They have been in the industry for 20, 30, 40, 50 years, and they still do not get this. It's baffling to me. But never forget, this is the key, that markets run up in anticipation of something good, and they're going down because they're anticipating something bad. Now, there are certain catalysts that can halt or abruptly change the collective view. So if the collective view is that 6 to 8 months from now, things are going to be worse off, let's get out now. Let's start unwinding now. Something can come along in the midst of that consciousness, in the midst of that view, and abruptly change that view. And it's those things that cause bottoms and tops. There are certain catalysts, certain things. You don't have to know what they are. Just when they happen, they abruptly change the view. And it's these bottoms and tops that are abrupt changes in the overall view of the collective participants. Now, one last thing I will leave you with is that I am constantly telling my traders, and I'm going to get rid of this smaller one here just for the moment, and I'm going to keep you with the 20-period moving average. I'm constantly telling my traders that you are to never look at anything technically without this simple moving average on your chart, the 20-period moving average. We use it as a support mechanism and resistance mechanism, as well as a basis for location. Now, the general theme to understand here is that stocks can get far away on the upside from the 20, but they cannot stay there. That is the key. They can get fairly deep below the 20-period moving average, but they cannot stay there. So these extreme locations away from this blue line, this blue 20-period moving average, will tend to create decent opportunities for snapbacks toward the mean and beyond. So here, Apple is way ahead of itself. How do we know that? It has separated itself very decently from its 20-period moving average. A decline is imminent. So any news that is even a little bit shaky will cause an avalanche and cause people to run for the exit signs. Why? Because everyone's profitable. And if everyone is profitable, then everyone's next move is a sell. It's usually not a buy. You see? So any nervousness, any hint of a problem causes a sharp drop from an elevated position away from the 20-period moving average. Well, when you've fallen deep through the 20-period moving average and reached a level that is fairly far below the 20-period moving average, then that basically means just like a wet sponge, when you squeeze it long enough, and the vast majority of the moisture in the water is out of the sponge. Well, this movement down is squeezing the water out of Apple, squeezing the excess out of Apple, squeezing the overboughtness out of Apple, eliminating the weak hands. And so at this point beneath the 20-period moving average, the weak hands are predominantly gone, the moisture, the water out of the sponge, and now the sponge can snap back. And so if there is a catalyst from under the 20-period moving average, a bullish catalyst, a surprise piece of news, a better than average, better than expected earnings report from below the 20-period moving average, that can ignite a very dramatic run back to the upside.
So you have to keep in mind that there are these things that can abruptly change, but the abrupt changes, the most violent changes, tend to occur from these locations far away from the 20. So if you can see this sharp drop in the year 2012 into 2013, that was a 1 year drop for the most part. That drop lost a big percentage of Apple's valuation from roughly 104 to the 50s, the high 50s. That is almost a 50% haircut. I mean, it's not quite, but the severity is lost because of this move upward. But this is a very, very sharp, debilitating decline for most people, especially if you bought far away from the 20, which, as my followers and traders today, you would never do now, because you know that's the area where people are nervous, and even the smallest degree of that's my alarm going off. Even the smallest degree of nervousness will cause people to run to the hills and dump the stock. You never want to be a buyer far above the 20-period moving average. If anything, you want to become an aggressive buyer on moves that appear to be reversing what caused the stock to drop deep below the 20-period moving average. So we're aggressive buyers deep under the 20-period moving average, and we're aggressive sellers far above the 20-period moving average. There are other sell points as well, but these are the aggressive points: aggressive selling, aggressive buying. Aggressive selling on red, well above. Aggressive buying on green, well below. Aggressive selling on red, well above. Aggressive buying on green, well below. Fairly simple, wouldn't you say? So let me leave you with this. After a 6-month run-up, we're likely to get some short-term pressure on Apple. That means that in my day-to-day trading, I will lean toward paying more attention to bearish signs. It doesn't mean that I will ignore any bullish signs, but I will place more weight on the bearish signs that reveal themselves simply because of my experience, which tells me that this 6-month run-up has been in anticipation of this fairly decent earnings report, and that people have profits and will interpret this report more as a sell event than a buy event. I hope that's been helpful.
Well, there you have it, traders. This is my general overall take on how to interpret earnings and how this earnings theme of mine can give you a very, very nice edge over the vast majority of participants who think in this very simplistic way that good news produces upward moving prices and bad news produces downward moving prices.